Crypto Hotep here with another investing video. We are on week 96 of the family portfolio and dividends tracker. Really appreciate you guys tuning in once again for a brief update on the family stock portfolio. Also, thank you again, whoever's been around since the first week. I really appreciate it. Much appreciated. The last video we had, it almost cracked 200 views. So it seems to me like we have some momentum going with the views. So again, really appreciate you guys watching these videos. If this is your first time watching a video, go to the channel, subscribe, and then go to week number 1. That'll go through my whole methodology and what I'm doing with my family here. And basically, you're following the investment journey with my family. I shortlisted a bunch of companies for them to choose from. They picked the companies that they understood, that most resonated with them, and then we proceed to use them on finance. You'll see shortly here to use their technology for our investments. And then every week we go through this investment portfolio. We go through the ups, the downs, how we're feeling about the markets, what's going on in the news, and overall, again, just documenting the whole investment journey. These videos aren't financial advice at all, so please do your own due diligence when you're investing in stocks. And before we jump in here, guys, if I have to clear my throat a couple times, allergies are kicking up here, but that's a good thing because that means that warm weather is close, very close by here. So to jump in here, guys, let's go through the weekly events from February 8th to February 13th and what's happened this week. So as a quick review, so the Dow Jones did hit a remarkable 50,000 high. It's the first time the Dow Jones Index has ever hit that high. Gold held above 5,000. Silver did not do that well this week. It was very volatile as well. Crypto, as far as crypto goes, Bitcoin endured further selling pressure, dipping all the way down to 65,000 before stabling or basing out between 66 and 69,000. Other things that happened in the news was, let's see, it was more, for me, it was related to more U.S. labor data, right? So we had the unemployment rate. The unemployment rate was lower than what was forecasted. Unemployment rate came at 4.4%. I believe the forecasted rate was 4.5%. So that's bullish, right? In addition to that, we also had CPI. CPI came in also lower than expected at 2.4%. That's huge. So not only do you have inflation coming down, you also have unemployment coming down, and then you have non-farm payrolls that have ticked up. So non-farm payrolls ticked up from 70K to over 100,000. So 100,000 more jobs came out into America's economy. All of those three factors are bullish for the economy as a whole. How did that resonate with our portfolio? Well, before we go to week 96, let's go to week 95. Week 95 saw us with a portfolio balance of $4,046.71, money weighted rate of return of 3.24%, dividends earned of $2.67, and a market gain of $122.45. It was really good. It rebounded from the previous week. So let's see what happened this week. Here. Let me just click out of this. There we go. So this week, week 96, saw us with a balance of $4,001.55. So we actually went down, and this week was a deposit week as well. So again, markets are doing that dance that they always like to do. So if we scroll down here, we had a market gain of $57.05. Dividends earned of $5.92. So we went up on dividends earned, which is a good thing. And then our money weighted rate of return is 1.63%. So we went down in there. So what actually happened? Okay, so between this week and last week, the biggest things are we had dividend payouts from Lowe's and Apple right here. So we had 27 cents from Lowe's, and that was in my portfolio. And then we had Apple. Multiple of us as a family own Apple. Excuse me. So this got dispersed evenly amongst everybody. We also had a deposit week, as I mentioned. So this is our regular deposit, $20. And again, if this is your first time watching the video and you're scoffing at that deposit or contribution, go and look at week number 1 and check out that balance. So with that $20 deposit, we bought several things. So we bought some Amazon, bought dip on Amazon. We bought Tesla. We bought Apple, Microsoft, and then we bought some McDonald's as well. And shout outs to McDonald's. They had fantastic earnings as well. And I know our oldest is going to benefit from that. So let's go from bottom to top here. Bottom, unfortunately, is our middle. But our middle, again, still has the highest year-to-date return. So our middle's balance is $555.01, 3.91% money-weighted rate of return year-to-date. Dividends earned of $1.75, and then market gain of $18.66. Target is still the anchor here, as I mentioned. Target is just getting cooking right now. They bottomed out at price for Target, and I really think there's a ton of more upside with Target. They're making some great moves from a corporation, a business standpoint, so it's going to be really exciting to see this position gain some traction. Costco, again, we love Costco over here, over 18% on Costco year to date. Amazon, we're buying the dip on Amazon. Amazon's down double digits. That's completely fine. So is Sony, but Sony, we're closing the gap on Sony, guys. So remember, when we're in these positions and it's red, we don't necessarily are nervous or afraid and want to sell out of that position. Especially with my kids, they've come to find out when we talk about investing, whether it be stocks, whether it be Bitcoin, whatever, when stuff goes down, they're like, okay, great, I can buy more of that at a better price. And that's how you want to look at it. Starbucks, again, Starbucks is doing the Target type of year here, where they're rebounding. They're doing things in their business for sustainability purposes, and it's evident. The markets are loving it. Over 12% on Starbucks. Google's down over 2%, not worried about that. And then Tesla down over 7%, not really worried about that either. Youngest, let's go to our youngest. So our youngest has a balance of $574.33, money weighted rate of return of 1.48%, dividends earned of $1.06, market gain of $7.13. So very similar to our middle. Costco doing its thing, Starbucks also doing its thing. Sony's in a very similar position here. Apple's down over 5.5%, but that's okay. I predicted that Apple would spike up at the very beginning of the year and then slowly trickle down for discounted prices. There's nothing to be worried about there. And then Tesla is down over 7% here for this as well. Let's go to my wife's. My wife's portfolio balance is $582.73, money weighted rate of return of a negative 0.93%, market gain of a negative $5.32. No dividends as of yet. That will change though with Pepsi upcoming. So Google down over 2, almost 2.5%. Pepsi up over 15.5%. Celsius down over 2.25%. So this is something to see. So Celsius, which was the catalyst for my wife's portfolio, we didn't change anything. We were buying dips on Celsius, not worrying about it. Now we're in the red on Celsius. The whole market itself is somewhat in a sell-off pattern right now. So this Celsius is just, it's the course of action right now. Tesla, very similar to everybody else, down over 7%. And then Microsoft, that position that we're continuously building in, we're down over 17% on Microsoft. Microsoft's going to get a little bit cheaper, and that's okay. That is completely okay. Let's go to our oldest. Our oldest, very good portfolio balance here of $1,143.48, money weighted rate of return of 2.84%, market gain of $30.47, and then dividends earned of 72 cents. Again, our oldest portfolio is the simplest portfolio out of anybody and has the least holdings. Only 4 companies. We have Apple, Costco, which we've already talked about with Costco, up over 18% on Costco, and then McDonald's doing its thing. So McDonald's, very good earnings from McDonald's, a lot of bullish signs for McDonald's as a company, up over 7% year to date on McDonald's. And then Tesla, very similar, down over 7% on Tesla. And then last but not least, let's look at my stocks. My stocks, unfortunately, we went down on my stocks. We are at $1,146 even, 0.76% year-to-date return, market gain of $6.11, dividends earned of $2.39. And if you look, let's look at my portfolio here and look at this chart. If you look here, we saw an all-time high of $11.67.87. That was towards the end of January. And this is how the markets are, guys. We didn't sell anything out of these markets, right? We didn't sell anything, but the market does what it does. And again, you have to be ready to ride the roller coaster here. This is even after putting money into the market. So you have to be comfortable with that. A lot of times people will put money into the markets and try to flip something really quick and try to get rich quick overnight, and that doesn't work. That's how you get broke faster. So you have to just understand, the companies that you're investing in and trust that the markets will turn around. We've just looked back at any of my videos when we were in a downward spiral, when our portfolio was in the red for months on end. And finally it turned around and we wound up ending last year at a positive double-digit growth. So again, this is what markets do all day long. I believe it was Warren Buffett who says markets award or take money from the impatient to the patient. So, it's a quote in itself, honestly, and it means a whole lot. It just means it's better to focus on companies that you know what they do and you can understand and you can hold them, and also get excited when you can buy them at discounts versus trying to buy something you have no idea of and you're just buying it because everybody on Twitter or X or TikTok, whatever, said to buy it and you know nothing about it. In terms of my portfolio, and I'll get off my soapbox, in terms of my portfolio, technology as of last week too, it's bringing it down, right? So as of right now, it's anchoring the portfolio, but unfortunately, it's bringing that portfolio down over 8.5% for technology. And if you're unfamiliar, I only hold 2 positions in my technology sector. That's Google and Microsoft, both down very considerably. But do I feel as though the fundamentals have changed with those companies? Not at all. On the finance side, we have Moody's and then we have Visa. Very similar, very boring companies, but they are compounders and nothing has changed with these fundamentals. I'll be happy to buy these companies at discounted rates. But everything else is in the green, surprisingly. O, which is our real estate sector here primarily, is up over 16% year to date. This is my income driver. O, just because of the dividend yield and the appreciation aspect of it. Industrials and energy. Industrial and energy sector is Waste Management and Cintas. Waste Management have fantastic earnings, right? Cintas is also looking to acquire another company. So these two long-standing, very boring companies are still doing things to expand their business. And look at this. We're up over 6.5% and up over 3% year to date. Okay. Consumer staples and shopping. So consumer staples and shopping, we have the GOAT, Costco, and then we have Lowe's. Costco and Lowe's both were in the red towards the end of last year, but guess what? We're up over 18 and 19, almost 20% year to date for both of them, right? It's more if you're looking at my portfolio, because my portfolio covers the gamut in terms of sectors, you can see more of money rotating out of speculative and technology stocks and rotating it into more value-added companies, right? So more companies that provide more consistent return, dividend-paying type of companies, and companies that have been around for decades on end, i.e. Costco, Lowe's, and such. If we look at restaurants and food, Domino's is kind of bringing everything down here at a negative 10%. But again, the GOAT, Coca-Cola, doing what it does here, up over 12.5% year to date. And again, I've seen this shift. I saw this shift very early, and I said, you know what, technology is going to take a breath. Does that mean that we're going to stop investing in technology? Nope, because technology is going to get a very good discount. We're still going to do that. But keep an eye out for those value type of companies, the companies that are very boring, that have been around for 3, 4, 5, 6 decades, that you know exactly what they do. It's not very complicated. Those are the companies that are showing very good returns as of right now in the markets. So guys, with that being said, that is week 96 with a portfolio balance of $4,001.55, market gain of $57.05, dividends earned of $5.92, and a money weighted rate of return of 1.63%. If this video was helpful, guys, please like, please subscribe. Let me know what you're investing in. I did get a comment last week that said, hey, with a portfolio like that, you could just put everything on Tesla or Bitcoin. Hey, look at some of my other videos and you'll see what we do. But as always, guys, thank you and happy investing.